In this lesson, types of indicators, the learning objectives are you should know the different types of indicators and you should know the benefits and drawbacks of using a trading indicator. Technical analysis often involves the use of trading indicators. Indicators are the visual representation of calculations that are usually based on historical prices used by traders to predict future price direction. They are very important in technical analysis. Every day there is an enormous amount of price data to be understood across all pairs. This data can be overwhelming, especially to new traders. So trading indicators are used to simplify the price data and present them in easily recognizable patterns. Let's look at the benefits of trading indicators. The main benefit of indicators is that they simplify price moves. New traders may find the simple movements of an indicator easier to interpret than the complex movements on the price chart. Indicators are an excellent tool for learning how to spot weakness or strength in the market. For the new trader, this may be difficult to assess on a price chart, but with the aid of indicators, they can be made aware of subtle changes they have not yet trained themselves to see on the price chart. Some indicators, like the moving averages, can help you confirm the direction of the price trend by filtering out the noise. Volatility indicators can help you adjust your stop loss based on the level of market activity on the currency pair. Momentum indicators can help you know when the price momentum is getting weak. Trading indicators as a whole are great for helping you find entries and exits. Let's look at the drawbacks of trading indicators. To a skilled trader, an indicator often won't reveal more than what is visible just by analyzing the price chart without any indicators. The main drawback of indicators is that while they appear easy to use on the surface, most traders have no idea how the indicator works. So they don't know when the indicator will provide good signals and bad signals. Every indicator has a vulnerability, something that makes it likely to provide trade signals at the wrong time, or not provide a trade signal at the right time. If you use an indicator, study the math underneath it, which is what I hope to do in the coming lessons. That way, you can work out the vulnerabilities. Also, don't just look at the times the indicator told you to do something and you won or lost. Also look at the times the indicator failed to warn you about getting into a trade or getting out of one. Another major drawback of indicators is that they're typically just showing you what is happening on the price chart, but in a different visual way. Price action traders feel indicators are redundant and not required because they can only provide information that price charts are providing anyway. Just for some clarification, price action traders just use candlesticks or line charts, for example. So, as I was saying, since indicators are calculated based on price, they tend to lag behind what the price is doing. Too many indicators can make the chart confusing as well, as it leads to analysis paralysis, where you get many conflicting signals. Let's look at the trading indicators types. There are hundreds of trading indicators available to traders, and more complex ones are being developed every day as traders continue to search for ways to improve their trading results. It is important to fully understand the strengths and weaknesses of each tool, so you'll be able to determine which ones work for you and which ones don't. So let's look at the different ways indicators can be classified. Overlay indicators are indicators that are placed on the main price chart, which follow the price movement. These include moving averages, Fibonacci tools, Bollinger Bands, parabolic SAR, Ichimoku clouds, and pivot lines. You do not need to know these, we'll cover these in future lessons. I'm just pointing out just so if you come back, you'll know what I'm talking about. There are also separate window indicators. These are indicators which are placed on a separate window from the main chart. They include the stochastic indicator, MACD, RSI, and ADX. They are usually placed below the main price chart. There are also leading and lagging indicators. Leading indicators give signals about price reversals before price changes direction. These indicators help you profit by predicting what prices will do next. However, when you use leading indicators, you will experience a lot of fake outs. Leading indicators are notorious for giving misleading signals. They include oscillators or momentum indicators like RSI. Lagging indicators give a signal after a new trend has started and acts as confirmation, working well when prices move in relatively long trends. They don't warn you of any upcoming changes in prices. They simply tell you what prices are doing, rising or falling, so that you can trade accordingly. This means that you will buy or sell late, but in exchange for missing any early opportunities, they greatly reduce your risk by filtering out false signals. Examples of lagging indicators include trend indicators, like moving averages, and volatility indicators, like Bollinger Bands. You should use lagging indicators during trending markets and leading indicators during sideways markets. Trend indicators are designed to show traders how the price is moving, telling you if price is trending or range bound. Some of them even show the direction of the trend, which may be upward, a bullish trend, or downwards, bearish trend, or sideways, range bound. Some of the examples of trend indicators are moving averages, average directional index, ADX, and the parabolic SAR. Momentum indicators are also called oscillators because they oscillate between two extremes or about a midpoint. They show the speed at which the price is moving over a given time. The ones that oscillate between two extremes often show overbought and oversold regions, and they include the stochastic indicator, relative price index, RSI, and the Williams percentage R indicator. Momentum indicators that oscillate about a midpoint include the moving average convergence divergence or MACD indicator. Volatility indicators help traders to measure the level of market activity in a pair. They indicate the relative magnitude price moves in the upward and downward directions. When the price moves up or down very quickly, there is high volatility, and when the opposite is the case, there is low volatility. Examples of volatility indicators include the average true range or ATR indicator, Bollinger Bands, standard deviation indicators, moving average envelopes, and Keltner channels.